The Federal Reserve just made its biggest announcement and biggest change to inflation and its bond buying and asset purchasing on Wall Street. On December 15th, 2021, the Federal Reserve announced that it was going to start aggressively dialing back a lot of its policies in order to combat inflation. Most of these new changes will have a massive effect on what happens to our economy in 2022. And overall, this could be the biggest Fed policy change in its 108-year history. So today I want to break down exactly what is in this new Federal Reserve report and everything that happened during the Federal Reserve meeting. I also want to talk a little bit about what this could mean for 2022 and beyond. But before I get into all of that, my name is Nate from Minority Mindset News, and if you like this video, then smash that thumbs up button below and hit that notification bell too. That way YouTube shows our videos to way more money minds around the world, and we can keep making videos just like this one. Diving directly into the report, the Federal Reserve said that it is no longer considering inflation transitory. In fact, it is no longer trying to aim for a 2% inflation rate in 2022. It thinks inflation will reach a point of around 2.6%, and that inflation by the end of 2021 will be at around 5.8%. That is a slow decrease and a slow decline from what we have seen from the Consumer Price Index over the last few months. In the most recent Consumer Price Index, it showed that prices and inflation was going up by around 6.8%. So that means the Federal Reserve believes that inflation is going to come down by almost 1% by the end of 2021. Next up, the Federal Reserve announced that it plans on raising interest rates 3 times in 2022. That is up from the 1 time that it said just a couple weeks ago. It could start raising rates right around springtime, with most experts predicting that this could happen between March and April. March and April are going to be a big month for the business and financial world in 2022 because the Federal Reserve also announced that it was going to aggressively start bringing back its quantitative easing and tapering on Wall Street. The Federal Reserve will now taper its asset and bond buying purchases on the New York Stock Exchange by $30 billion every single month. This would allow it to stop all of its quantitative easing measures by sometime in March of 2022. Going off of the direct report here, the Fed will be buying around $60 billion of bonds each month starting in January. That is half of what it was doing in November, and it's even less than what it was doing in December. So you can kind of see how they're starting to aggressively accelerate their tapering. In addition, with the interest rate hikes that are coming in 2022, the Federal Reserve also announced that it will most likely begin to raise its interest rates 2 times in 2023 and again another 2 times in 2024. This is all in an effort to combat inflation. Inflation has hit its highest point in almost 40 years. Like I said, the Consumer Price Index showed that the average price of just about everything in the United States was going up, and it went up by around 6.8% in November. Also, on the business side, the Producer Price Index showed an increase of around 9.8%. That is the largest increase we have ever seen in inflation since the United States has been tracking these numbers. However, in the new report, the Federal Reserve and Jerome Powell still are holding strong that all of our supply chain issues are the real reason behind all of the inflation within our country. And that if things continue to get worse in 2022 and 2023, the Federal Reserve will get even more aggressive with interest rates and cut off bond buying and asset purchasing even faster. And I will say a lot of the economic stimulus that the Federal Reserve and the federal government has been pumping into our economy over the last 2 years has already completely disappeared. At the beginning of the pandemic back in March of 2020, the Federal Reserve and the federal government decided they needed to pump up our economy by printing trillions of extra dollars and then giving that money to the American people. The reason for this is because all of our industries were starting to crash. And when everything was crashing, everything was closing. And with everything closing, nobody was making any money. This meant that consumers couldn't buy anything. And if consumers can't buy anything, then businesses can't buy anything either. All of that was going to cause a problem within our economy because there's just no money circulating around. And couple that with the pandemic and the uncertainty of when things are going to open back up, the Federal Reserve decided it needed to pump trillions of dollars back into the economy so people were incentivized to spend. They also dropped their interest rates down to around 0% so that people would have more access to getting a loan. This meant that the Federal Reserve needed to print more money so it could give to the banks, and that way people could get get even more money. What this ultimately led to is inflation. Inflation, by definition, is when a country's monetary supply starts to increase. And when the monetary supply of a country increases, the value of every dollar in that economy starts to go down. That means that you have to pay more for everything that you were buying before, meaning the buying power of every dollar you have is decreasing as well. That so far has led to massive inflation, mostly because people were spending a lot more money in 2020. And I know what you're thinking, Nate, you just said that people were out of jobs, which means they couldn't go out and spend money. But they did because the Federal Reserve was providing so much money. The Federal Reserve loosened its policies to their lowest point that it ever has in its 108-year history. And now it's turning around and probably getting more strict than it ever has before. Because people were getting thousands of dollars in the form of extended unemployment benefits and direct stimulus payments that sometimes equaled thousands of dollars, people were going out and buying an abundance of things. And that meant that producers couldn't meet demand for all of their products. Our supply started to go down as our demand was going way up. This ultimately continued, and it's why we are facing such high inflation right now. Because suppliers just can't get enough product out, everything is starting to cost more for the American people. And because of the Federal Reserve's decisions over the last 2 years, pretty much everything has been in short supply because everything has been made very available for just about everyone. Homes exploded in 2020. The reason for this is because people could go out and get a home with such a low interest rate that they might not have been able to afford before. This meant that the supply of homes was shrinking and the price for a home was going up. And right now, housing prices are 20% higher than they were pre-pandemic. In addition, the auto market was affected as well. New vehicles were not being made because of our demand for electronics. We have these little microchips and semiconductors in most of our electronics. It's what makes them run. However, as demand went up for those and our electronics in general, people couldn't get them. And the cost of everything in the tech world started to go up, including new vehicles. Microchips and these semiconductors are in new vehicles as well, and the auto industry started to slow down. This actually made the price of a used vehicle go way up, which is crazy because used vehicles typically only lose value over time. Another thing the Federal Reserve said in its latest report is that it's going to continue all of these policies until United States employment reaches its maximum levels. In a statement from the Federal Reserve, they said that they seek employment that was both full and inclusive across racial, gender, and economic lines. Once they achieve that, they can start raising interest rates, and many experts believe that that will start in the spring of 2022. That is a lot different than what we've seen in the past, because as inflation starts to raise, the Federal Reserve starts to pull back a lot of its monetary policies, including raising its rates. Raising rates essentially means that people will not have as much access to money. They won't be able to go out and get a mortgage or an auto loan or any type of loan for that matter. It'll be a lot harder for people to get money, which means spending will ultimately go down, and when spending goes down, you have a lot less money circulating throughout your economy, which means inflation will start to go down too. The past Federal Reserve has actually raised interest rates in anticipation of inflation. This way they can get ahead of inflation and stop people from spending before they actually do. This time is a little bit different though, because they have to be very careful about how they approach inflation. If the Federal Reserve actually comes in and drops a lot of its interest rates too fast, then that means that people are going to have way less access to money all at once. Eventually, you'll start to see mortgage application rates drastically decrease. This means that a lot less people are going to be going out and buying a home, so the real estate market could crash. In addition, the stock market is going to run into a big problem if the Federal Reserve pulls back a lot of its tapering measures too fast. Since the pandemic started and the Federal Reserve has entered Wall Street and started its quantitative easing measures, it has bought around $8.7 trillion in assets on Wall Street. We are talking hundreds of billions of dollars being poured into the New York Stock Exchange. If that money disappears too fast, then all of the businesses and all of the investors who have benefited from that over the last 2 years are suddenly going to start losing all of their money. This could send the stock market into correction or even crash territory depending on how fast the Federal Reserve does this in 2022. But so far they have given us a little bit of a timeline and said that they're going to do this around the springtime in 2022, and just after, they will start raising their interest rates back up from 0%. Once the Federal Reserve ends its bond buying program, it can do one of two things. It can start selling a lot of those bonds back on Wall Street, or it can let a lot of these bonds just start to run off. Essentially what that means is the money just kind of runs out for those bonds. One of the biggest factors for the chairman of the Federal Reserve, Jerome Powell, the United States government, and the Federal Reserve in general is this new Omicron variant. We don't really know much about the Omicron variant, and it's spreading very fast throughout the United States and the rest of the world. The UK just a few days in December reported that it had its first Omicron-related death. And like I said, the Omicron variant is spreading throughout the United States. Now, the Delta variant is still the biggest variant in the United States. However, if the Omicron variant becomes very powerful, it could end up closing things throughout the United States. Again, like we saw in 2020. Now, President Joe Biden has already said that we are not facing any economic lockdowns at this point. However, we don't really know what is going to happen in the future. He hasn't really taken it completely off the table because we don't really know much about this virus yet. But if businesses need to shut down or people are just overall scared of going out, then you'll see spending start to decrease in the United States. That means our GDP is going to go down too, and our next GDP report for Q4 2021 is expected to be around 2.1% of growth. That may begin to change if a lot of businesses start to go down, and the Federal Reserve is not out of the woods yet, because if the United States economy starts to collapse again, they'll be faced with the same decision that they were in March of 2020. Do they step in and provide trillions of dollars in stimulus, or do they let the nation fail? So really the biggest variant right now for the Federal Reserve is this Omicron variant. If that starts to go away and is not a problem, then our pandemic may start to end completely as well. But right now it looks like Jerome Powell and the Federal Reserve is finally starting to admit that inflation is no longer transitory, and it's going to be a lot higher next year than even they anticipated. But all of these moves are in an effort to combat inflation, and there's consequences on both sides of the aisle here. If they do nothing, then inflation will continue to rise and continue to rise in the United States. That means that everything is going to cost everyone more, consumers and businesses alike. However, if they actually do something, then the real estate market and the stock market are going to start going down because there's going to be a lot less money circulating throughout our economy. It's important to mention here that there has been a ton of money throughout our economy over the last 2 years. More money than we have ever seen all at once. That is definitely not normal. So this may just get us back to what is considered a normal rate. And this will definitely not be the last time the Federal Reserve is in the spotlight and in the news headlines. So as things continue to progress in 2021 and in 2022, we will definitely keep our eye on all of these policies and the economy in general. But now I want to hear from you on this issue. What do you think about inflation and the new Federal Reserve moves? Is the Federal Reserve getting way too aggressive with inflation, or is this not aggressive enough? They need to do more in order to combat inflation. In addition, how do you think these policies will help our economy fare in 2022? Will we have a very positive growth year for our economy, or will inflation and a lot of other economic factors like the Omicron variant crash our economy again in 2022? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you liked this video, make sure to hit that subscribe button below. Keep hustling, money minds, and I'll see you all in the next one.